Geopolitical risk premiums are unwinding faster than anyone expected. That $83.55 resistance level? It's holding firm. And if we lose $81.50 support, we're looking at $77. I've got 2 scalping setups and a swing trade ready for this exact scenario. Watch the full breakdown on my channel Trade Meridian Decoded. The Strait of Hormuz just experienced an 88% collapse in maritime transit flows. 2 cargo vessels. That's it. In a 24-hour cycle. And yet here we are, sitting at $82.21 on Brent Crude, barely moving. What does that tell you? It tells me the market has completely priced out the geopolitical premium. That the smart money is looking past the headlines and staring straight at the IEA's August oil market report due Thursday. Let me be blunt with you. I've been trading energy markets for over 20 years, and I have never seen a disconnect this wide between real-world supply disruption and paper price action. Something has to give this week. The question is which way. This is the Brent Crude week-ahead breakdown for 10 to 14 August. And I'm going to show you exactly how I'm navigating what I believe is the most volatile setup we've seen since the August 2022 liquidity grab. Stick around because the levels I'm about to share could save you from getting caught in a violent reversal. Here is my weekly verdict, plain and simple. I am bearish biased on oil this week, with a base case target of $77. That's right. I expect a full retest of the structural support level that held back in July. Now, let me be crystal clear about my invalidation level. If we see a daily close above $84.44, the bearish thesis is dead, and we are looking at a breakout toward $86.50. But that scenario requires 2 things. A collapse in the Iran-Oman negotiations and a cooler-than-expected US CPI print. I don't think we get both. The market is currently sitting at a weekly pivot point of $82.90. And my experience tells me that when you have a weekly downtrend of over 7% and a consolidation pattern forming right under resistance, the path of least resistance is lower, not higher. And here's the part that keeps me up at night. The ADX reading is sitting at 22.4, indicating a weakening trend. The market is going sideways into a tight range. That's the calm before the storm. The question you need to ask yourself is whether you want to be caught long when that storm breaks. Let me take you through my technical process the way I actually trade it. I start with the weekly chart because that gives you the structural context that intraday traders completely miss. Brent Crude is down over 7% on the weekly time frame, off the August peak near $85.85. That's a massive unwinding of risk premium. The weekly candle is a bearish engulfing pattern, which for me is a clear signal that sellers are in control at higher levels. But here is where it gets interesting. The weekly RSI is sitting at 48.6, which is neutral territory. That tells me we haven't reached extreme oversold conditions yet. There's room to fall. The weekly MACD is showing a bearish crossover that's still in its early stages. If this plays out the way I've seen it play out before, we could be looking at a multi-week decline toward that $72 handle, now moving down to the daily chart. This is where the real battle is happening. The price is consolidating under key resistance lines after that sharp pullback. The daily RSI is at 46.8, leaning slightly oversold, but not enough to trigger a bounce. The MACD on the daily is negative at -0.45, and the bearish crossover is ongoing. What stands out to me is not the headline levels, but the moving average structure. The MA5 is at $82.35, the MA10 is at $83.10, and the MA20 is at $83.45. All of these are sloping downward. The MA50 is at $81.20, and that is actually acting as dynamic support right now. But the MA100 at $84.10 and the MA200 at $82.80 are telling a different story. The MA100 is still above price, which is bearish, and the MA200, well, we are actually below that 200-day moving average. That is a critical bearish development. Let's go down to the 4-hour chart because this is where I'm looking for the actual execution signals. The 4-hour time frame is showing clear selling pressure on continuous macro updates. Every rally attempt is being sold into. And the 1-hour time frame, which is what I watch for scalping entries, has flattened out during the early Asian market session. That tells me we are in a low volatility consolidation phase, which is typical before a major data release like CPI and the IEA report. I want to share a personal observation with you. I've seen this exact divergence 3 times in my career where the weekly trend is bearish, the daily consolidates, and the 1-hour flattens out. Twice it led to a violent reversal to the downside. Once it led to a sharp squeeze higher. The difference in each case was the catalyst. In my view, the catalyst this week is going to be the IEA report. If that confirms a global supply glut, we are going to blow through 81.50 support like it's not even there. Now let's connect the fundamental picture to these technical levels because this is where the real tension lives. The Strait of Hormuz situation is genuinely concerning from a physical supply perspective. Only 2 cargo vessels transited the region within a single 24-hour cycle. Saudi Arabia is now forced to pay a $5 per barrel structural premium to bypass the blockage via pipelines. That is real money. That is a real supply shock. And yet, the price is dropping. Why? Because the market is forward-looking. Traders are looking past the current disruption and staring at the medium-term supply picture. And that picture, according to the IEA, is a global crude surplus that's expanding. Citigroup just shifted its near-term Q3 Brent price target up to $80 due to slower progress in US-Iran diplomacy. But they also maintain that medium-term targets will drop closer to $65 by late 2027. JP Morgan is pegging Q3 Brent at an average of 86 before easing to 80 in Q4. The common theme here is that everyone expects prices to come down over time. The only question is the timing of the next leg lower. Now let me walk you through the calendar because this is where the volatility is going to come from. Tuesday, August 11th, we have the API weekly crude stock estimates. This is your first look at whether US inventories are building or drawing down. Wednesday, August 12th, is the big one. US Consumer Price Index data. This dictates US dollar direction. Higher inflation reduces Fed rate cut bets, which would pressure commodities lower. A cooler CPI print could trigger a risk-on rally and potentially break oil higher. But here's the catch. Even a cool CPI might not be enough to save oil if the IEA report delivers the supply glut narrative. Thursday, August 13th, is absolutely packed. The IEA August oil market report launches alongside the US PPI and the core EIA weekly petroleum status report. That is a trifecta of high-impact data. Here's my personal take on how this plays out. The IEA report is the key. Markets are going to trade sideways until that report drops, and then we are going to see an explosive move. I think the risk is to the downside because the supply surplus narrative is well known, well documented, and I believe it's going to be confirmed by the official data. But there's another angle that very few people are talking about. Demand destruction across Asian chemical sectors. That's the offsetting factor that JP Morgan analysts are highlighting. And they're right. When you see chemical manufacturing slowing down in Asia, that's a leading indicator for oil demand. So even if the geopolitical premium tries to reassert itself, the demand side of the equation is going to cap any rally. All right, time for us to get into the actual trade setups. This is where we turn analysis into action. I'm going to give you 2 scalping setups for the next 24 hours and 1 swing trade for the 5-day outlook. These are exact levels with exact triggers. No ambiguity. Scalp setup number 1. The mean reversion at support. This is a long scalp setup based on mean reversion within the tight range. The key support level to watch is $81.50. I am looking for a 5-minute candle to reject this structural support with a bullish pin bar or a bullish engulfing pattern. The entry trigger is a clear rejection candle that closes above the open of that 5-minute bar. My stop loss goes at $81.15, which is 35 ticks below entry. This gives me enough room to breathe without getting stopped out by noise. My take profit is $82.35, which is the MA5 dynamic resistance cluster. The risk-reward ratio on this setup is roughly 1 to 2.2. The invalidation condition is if we break below 81.50 with conviction on high volume. If that happens, I'm not fighting the tape. I'm waiting for the next setup, scalp setup number 2. The resistance rejection. This is a short scalp setup based on the same mean reversion principle, but at the top of the range. The key resistance level is $83.55, which is the previous session's high swing. I am looking for a clear failure to break above this level on the 5-minute chart. The entry trigger is a bearish rejection candle that closes below the open. My stop loss goes at $83.95, which is 40 ticks above entry. My take profit is $82.20, which is the current volume point of control. The risk-reward ratio on this setup is approximately 1 to 2.8. The invalidation condition is a high-volume breakout above 83.55. If that happens, this scalp is off the table and I'm looking at the swing trade scenario instead. Now I want to share a quick observation about scalping oil in this environment. I have been trading this exact range-bound setup since Friday, and the market maker behavior is very predictable. Sellers are stacking at resistance. Buyers are stepping in at support. But the ranges are getting tighter, which means volatility is compressing. That compression is going to lead to expansion. When the expansion comes, I want to be on the right side of it, and here is where I pause for a moment to ask you a question. I want you to drop a comment below and tell me what level you're watching this week. Are you focused on that 81.50 support or the 83.55 resistance? I read every comment, and I actually incorporate community sentiment into my daily analysis, so let me know what you're seeing in your own charts. Swing trade. The structural breakdown. This is the trade I'm actually looking to execute on the 4-hour or daily close. The setup is based on the bearish base case scenario. I want to see an unfulfilled retest of the weekly pivot point at $82.90 or structural resistance at $83.55. The entry trigger is confirmation of lower highs on the 4-hour chart. What does that look like? It looks like a rally to $83.55, followed by a rejection candle that closes below the midpoint of the previous up bar. That's my signal to open a tiered short position between $82.90 and $83.55. My stop loss is at $84.65. That's a daily close above a 2. Which would completely invalidate the structural bear thesis. If we close above that level, the bearish scenario is dead and I'm looking at the breakout scenario instead. My first profit target is $80 even. That's a logical level because it's a psychological round number and it sits right below the MA50 dynamic support. My second profit target is $77. That's the major cyclical macro support line that held back in July. I believe if we break below 81.50, this level is coming into play within 5 trading days. The risk-reward ratio on this swing trade is exceptional. If I enter at $83 and my stop is at $84.65, my risk is $1.65. My first target at $80 gives me a $3 reward, which is almost a 1 to 2 risk reward. My second target at $77 gives me a $6 reward, which is nearly a 1 to 4. That's the kind of asymmetric risk profile that I love. Now let me also outline the bullish escalation scenario because you need to know what would trigger me to flip long. The bullish setup is a sudden collapse of the Iran-Oman negotiations, paired with a broader risk-on rally driven by a cooler-than-expected US CPI print. The entry trigger is a decisive, high-volume 4-hour candle breakout above $84.44. My stop loss goes at $83.20, which is placed back inside the broken consolidation zone. My first profit target is $86.50, which is the August high. My second target is $89, which represents an unwinding of prior short positions and a potential squeeze higher. I don't think we get this scenario, but I have to respect the possibility. Let me take 30 seconds to talk about risk management because this is where most traders fail. I have a strict rule for oil. I never risk more than 1% of my account on a single trade. But here's the twist. In high volatility environments like this week, I actually scale that down to 0.5%. Why? because the news flow is unpredictable and the spreads can widen out significantly during data releases. I learned this lesson the hard way back in 2014 when I got caught on the wrong side of an OPEC announcement. I was over-leveraged, the spreads widened, and I got stopped out at a much worse price than my intended stop level. That one trade cost me 3% of my account, and it was entirely preventable. So my personal rule is this. Position size is determined by the volatility-adjusted stop distance, not by how confident I feel about the trade. If the ATR is $2.15 like it is right now, I reduce my size by at least 30% compared to what I would trade in a quiet market. And I always have a contingency plan for unexpected headlines. The scalper's rule on the screen right now is to invalidate all open parameters immediately if unexpected headlines break regarding the Oman-Iran maritime framework. Don't get caught holding a position through a news shock. So let me summarize this week's outlook for Brent Crude. The key level to watch is $81.50 support. If that breaks on high volume, we are heading to $77 within the week. The resistance level that needs to hold is $83.55. If we break above that, the entire bearish thesis is under threat. But based on my analysis, I believe the path of least resistance is down. The geopolitical premium is unwinding. The IEA is about to confirm a supply glut. And the technical structure is heavy. Now I want to leave you with one thought. I've been in this business long enough to know that the biggest moves come when everyone is looking the other way. Right now, everyone is looking at the Strait of Hormuz and the geopolitical tension. The market has already priced that in. The real trade is on the demand side and on the supply surplus data that nobody is talking about. That's where the opportunity is this week. So if you want to see my live updates as these levels get tested, make sure you have notifications turned on because I'll be posting intraday analysis when I see the setups trigger. And this Friday, I'll be back with a full weekly recap and a look ahead to the next week's trading. I also have a Sunday night pre-market video coming out every week where I adjust my levels based on weekend news flow, so make sure you catch that as well. Before I go, let me ask you one more time. What level are you watching this week? Drop it in the comments below. I actually read and respond to these. If you found value in this breakdown, hit that like button, subscribe to Trade Meridian Decoded, and join a community of traders who actually think for themselves. We don't do hype. We don't do emotional trading. We analyze the data, we respect the levels, and we execute with discipline. And remember, trading is a marathon, not a sprint. Protect your capital. Stick to your plan. And I'll see you in the next one.